Hello and welcome to CrossTalk, where all things are considered. I'm Peter Lavelle. How low is low? The price of crude is half of what it was only a few months ago. Well, consumers welcome cheaper energy costs. The oil industry faces bleak prospects. What is driving the oil price, and what are the wider implications for the global economy? To CrossTalk Oil Prices, I'm joined by my guest, Steve Hankey in Baltimore. He is a professor at the Johns Hopkins University and a senior fellow at the Cato Institute in Washington. And in Moscow, we cross to Yaroslav Lisovolik. He is the chief economist at Deutsche Bank, Russia. All right, gentlemen, CrossTalk rules. In effect, that means you can jump in anytime you want, and I very much encourage it. Steve, in Baltimore, if I can go to you first here, what is driving the price of oil, and why such a dramatic collapse of the oil price regime in such a short amount of time?
Well, this was a mystery to all the forecasters, investors, and oil companies when we started the year, last year, I should say. No one had a clue that the oil price was going to collapse. The consensus on Bloomberg for the end of the year oil price in 2014 was $105 a barrel. Yeah. And the most bearish prediction was by Ed Morris at Citibank. He was down at $75 a barrel. So, in fact, no one knew what was going to happen and anticipated it. What did happen is that the shale revolution in the United States, in particular, just kept pumping out oil, and everything in the markets are always determined at the margin, and this shale boom is a marginal producer. And so you have that supply element coming in and a little bit of weakness on the demand side, and there you go. All of a sudden, we're back to 1985, 1986, or 1996, 98, when oil prices collapsed by, roughly 60, 70% in a short period of time.
Yaroslav, if I can go to you here in Moscow, I mean, a lot of people are saying that the Saudis have taken the shale revolution in the United States really seriously, and that's one of the reasons why they're not moving on the oil production. They're worried about the Americans and their ability to be able to produce a lot of energy that was not on the market before. So is this kind of an overreaction, a spooked reaction on the part of the leader of OPEC?
Well, I think it's certainly an effort to try to protect the market share. Yeah. And clearly, there were issues with that previously. And clearly now the shale revolution in the U.S. is seen as a challenge, as a factor that is likely to operate in the markets for the foreseeable future. And clearly, there is an effort to try to win market share, and hence such an emphatic reaction. But overall, I think clearly in terms of what we're seeing today, it is about supply more than anything else. I agree that to some degree there may be an issue with demand as well, and demand is relatively soft, and you don't see as much of a vigor and dynamism coming out of the global economy. And I think really in terms of how drastically the change in the oil price has taken place, I think that also points to the fact that it's mostly an adjustment that reflects supply side factors.
Yeah, but Steve, is it really supply and demand here? I mean, because I still can't understand why it would drop so radically if it is the supply and demand. I mean, people just didn't wake up one morning a few months ago and say, oh my goodness, there's a lot of oil out there. I mean, there's a lot of professionals in this business watching this. Again, do the fundamentals match the price, current prices of today?
Well, I think what I said originally, Peter, was that no one anticipated this. None of the forecasters, none of the oil companies, none of the investors saw this thing coming. So it really did come out of the blue in a way. And if you don't anticipate something and then wake up one day and see that you're accumulating stocks and inventories of something that somebody doesn't want to buy, the price adjusts very rapidly. And I said in 1985 and to 1986, when OPEC collapsed the first time, the oil prices went down 70% in 5 months. And then the second time we witnessed exactly the same kind of thing was 96, 98. Oil prices went down 61% in 21 months. This time, we've been going about 5 months with this thing, and oil prices are down about 50%. So the adjustments, once the market comes to their senses and realizes what the realities are out there, adjustments happen very, very rapidly. Now, one thing that's important in this adjustment process is the fact that the shale oil production it doesn't have very much of a life. Once you have a well, you can be in 13 months. You can only have maybe 10% of that oil well left. You can produce virtually the whole thing, and it's exhausted. So what's happening out there is that the rig count, the number of new wells is collapsing. It's going down very fast, but the shale supply won't come down. It won't be affected by prices until a few months. And then we will have a very rapid reduction in supply, and price will start firming and going back up again in the second part of the year.
Yaroslav, it's really quite interesting as we can stay on the oil shale story, because prices are dropping so radically. All of a sudden, oil shale is just not viable anymore. Okay, there's going to be a certain window where it's just going to be very expensive. I mean, this is kind of a vicious circle. What's your crystal ball say? Second half of the year, we'll see more firming of prices?
Yes, I think this is probably what a lot of the observers are starting to perceive as one of the base case scenarios for 2015, namely that in the very near term you may well have still the overshooting of this decline in oil prices perhaps further below $50 per barrel, but given the fact that clearly then the viability of shale oil projects will start to become an issue, a lot of the people looking at the oil market are expecting that indeed in the second half, towards the second half of the year, you may well have a situation whereby the reduction in supply coming from shale oil will drive a lot of the recovery in the oil price. And I think the markets are starting to gauge that kind of trigger as one of the potential points of turnaround for the market, for the oil price. If the dynamics of oil production indeed starts to send a signal that we are at a stage where cuts are starting to take place, then I think you will start to see a relatively rapid adjustment in terms of oil price dynamics.
You know, Steve, if we can go back to history, you're bringing up the 1980s, and there are some economists saying that we're going to return to that kind of oil regime of the 1980s. How will the oil companies get through that? Because you need to be able to turn a profit. I mean, cheap oil is not doing them any good at all, and their capital expenditures, are very much in doubt.
Yes, well, this is part of the Saudi strategy, of course. They want to, it isn't so much that they want to gain market share, they want to protect their market share from these new entrants. And they don't want to operate like a swing producer that would reduce their production just to keep prices elevated, because the elevated prices just invite these higher cost producers of tar sands in Canada and oil shale in the United States into the market. So the Saudis want to cut the marginal producers out of the picture. And they do that with this low price strategy, keeping their production up. And what's that do? It eliminates or reduces cash flow to these shale oil producing companies, number one. And number two, it throws a lot of risk into the picture that increases their cost of capital going forward. And that will make it harder for them to raise capital and borrow money going forward. And so in a way, when they go out in a year or so and want to contemplate producing more and drilling more, they are going to find that their costs of capital are higher, and they won't be able, at the margin, the marginal ones won't be able to be as aggressive as they've been in the past. So in that sense, we will have a reduction in supply relative to what it would have been if the Saudis would have been operating as a swing producer, reducing production and keeping prices high. Okay. So I think prices will firm. They won't. I don't think they'll go back up to where they were, Peter.
Yeah.
And that gets into this kind of. I think the new regime will be kind of a ratchet thing, where we gradually ratchet down the prices over a long period of time.
Okay, Yaroslav, I'll go to you before we go to the break here. Is this a game of chicken the Saudis are playing? They need to have higher oil prices for the longer term. I guess it's your definition of the short term on all sides.
Yes, indeed. I think the question is how long the U.S. supply will be able to tolerate or to stomach such low oil prices. But clearly, in the longer term, I think you also see it in terms of oil prices on which the countries in the Gulf are basing their budgets. Clearly, in the longer term, the oil exporters are very much interested in higher oil prices. And eventually, I think once you start to see some kind of reaction in terms of lower supply coming out of the U.S., I think you'll start to see more emphatic efforts and steps on the part of main oil exporters towards higher oil prices.
I'm going to jump in here, gentlemen. We're going to go to a short break, and after that short break, we'll continue our discussion on oil prices. Stay with RT. All right, we're also now joined by Jasper Lawler in London. He is a spread betting broker at CMC Markets. Jasper, thank you for joining us. We've been discussing low oil prices. How low can oil prices go considering the environment and the fundamentals of the oil market? Because there are quite a few people who are saying it could go much lower. Is that possible in your mind?
Certainly anything's possible. We've been seeing a bit of a recovery off this $50 per barrel mark in Brent. Now it's acted as a bit of sort of technical support to stop the selling. No one's really buying at the moment, but at least it's abated the selling. I guess if we look at 2008, that's an obvious target. That's about $35 per barrel.
Yep.
I think really what it comes down to is just the cost of production and how long that takes to play out in terms of the producers and how much it costs for them to get out of the ground.
Okay, Steve, let's go back to 2008 because that's a very interesting parallel because, you know, we had the Great Recession. We saw a lot of meltdown and a whole lot of pain. So the drop of the oil price seemed to have made sense. We don't have that kind of environment now. How would you compare getting the return of the oil price, comparing this environment to the end of last year, this year, and 2008?
Well, I think it was there were some elements that are similar, but the key thing that was going on in the panic of 2008 was the dollar was soaring relative to the euro. Now, the dollar has gone up relative to the euro now. But then it was soaring, and we had a huge collapse, not only in oil prices, but gold prices and all commodities in 2008. So it was really a complete move towards safe assets, the U.S. dollar, and many bubbles simultaneously popping at the same time. And I don't really see that right now. This is really a little bit of a dollar strength, but mainly an oil market issue where everyone was caught by surprise with their pants down, so to speak, in terms of forecasting this market, and they just got caught out. And we're seeing a fast adjustment.
A fast adjustment here. Yaroslav, one of the reasons why I wanted you to come on the program is to discuss the adjustment that Russia is having to make with this drop in oil price. A great deal of the Russian federal budget is dependent on the export of energy. I'd like to also preface, I've known Yaroslav for many, many years during my time here in Russia, and we've had this constant conversation is that there would have to be a trigger to make the government change its policies, to swallow some tough medicine and to diversify shy away from the energy markets for at least dependency. Yaroslav, couldn't find a better moment to do it, could we?
Exactly. I think if there's some good that can be obtained from this challenge that is presented to Russia's economy, it is precisely that, to use this as an opportunity to pursue the difficult reforms that were not pursued before, specifically structural reforms in the budget sphere, to have more of a monitoring framework on the efficiency of budget spending, to have far more efficiency at the corporate level, and to make sure that the costs of state companies are not elevated. We simply need, finally, Russia to be able to make difficult decisions to enforce what was previously called hard budget constraints.
Yep.
We need to reintroduce that concept now as well, and for Russia to be able to operate by that concept. I think it's very important that we start to focus on productivity, on efficiency. Clearly, the growth that we had before in the past 10 to 15 years to a significant degree was supported by favorable terms of trade, by high oil prices. And now is the time for Russia to change the quality of its growth and to lay the foundation for higher sustainable growth rates through reforms.
Okay, Jasper, let's look at some of the other impacts of this oil price. Go ahead,
Peter,
jump in. Jump in. This is CrossTalk. Go right ahead.
Yeah. May I just? This is a two-handed intervention, and that is. The words hard budget constraint were uttered, and the problem Russia has, they made a disastrous mistake on November 11th when they floated the ruble. The only way you can get a hard budget constraint in a country like Russia is to have an absolutely fixed exchange rate. And they have a floating exchange rate, and this is putting them in a position where they will have trouble controlling their budget. They'll have a soft budget constraint. And I think November 11th was a bad day when they floated the ruble.
I think it's very difficult to maintain a fixed exchange rate when oil prices are so low.
Yeah.
And clearly you're going to have pressures on reserves, and Russia has been experiencing significant pressures with regard to reserves. And then, of course, on the back of these oil prices, you will have significant changes in Russia's macro fundamentals, including not just the budget balance, but also the trade balance, the current account balance, which with time will deliver negative implications for Russia's reserves and other macroeconomic variables. So I think a fixed exchange rate is quite problematic, quite difficult to maintain. I would agree that probably such a drastic adjustment of the exchange rate shouldn't have taken place, but some kind of a depreciation was warranted simply because of the tremendous change in macroeconomic fundamentals.
Okay, Steve, you want to reply to that before I go to Jasper in London?
Well, on just very quickly, we don't want to get out in the weeds too far with the debate about exchange rates, but let me just point out that all the Gulf countries, all the major oil producers in the world have fixed exchange rates to the dollar because oil is invoiced and priced in dollars, and they don't want the instability associated with selling something like oil priced in dollars and having a floating exchange rate. That's why the Saudi rial is fixed to the dollar. The UAE dirham is fixed to the dollar. The Kuwait dinar is fixed to the dollar. These people know in the Gulf what they're doing. They maintain fixed exchange rates, and that is why. And with Russia being the biggest oil producer in the world, they should have seriously, and they still should seriously look at a fixed exchange rate regime.
Okay. Well, that's a big debate here, and we could have a separate program on that. And I can tell you, being someone that lives here and earns rubles, I'm concerned about it very much. So I know Yaroslav is as well. Jasper, if I can go to you and can slightly change gears here. I mean, with this dramatic change in the oil price regime around the world, let's talk about renewables and green technologies and things like that. I mean, how long does it take? I mean, if we have an environment like this for a year, 2 years, 3 years, what's the impact on what people want to do and get away from fossil fuels?
Well, I suppose it comes to this argument about peak oil. Peak oil was the big reason to push into renewable energies. And a lot of people are calling into question, or at least recently were calling into question peak oil because there is this whole new supply coming into the market from the shale boom. I would argue to an extent maybe just redefine peak oil. Peak oil is maybe just the using up of the more efficiently produced oil, but it really, it just means that shifting over to the higher production. So I think just that very nature of the fact that we'll be moving gradually over time from the lower cost to the higher cost production just means that oil prices are going to eventually come back higher over time with that.
Okay, Steve, if I can go to you, how is this helping or putting into question the European recovery, its economy? Because lower oil prices, people do need that. Consumers always appreciate it. Is it going to have a positive effect? It's only been a few months right now. And like you said, everyone was caught asleep at the wheel. Maybe there'll be some other things that'll happen. But what about the global growth and looking at the Eurozone and specifically?
Well, the first reaction was that kind of a Keynesian knee-jerk reaction, that this would be like a tax cut, you see, to have lower oil prices, and it would stimulate the economy. But then the second look has been a more sober, realistic look, where people are worried about the uncertainty that's getting thrown into the market, the risk, volatility in oil prices, a major commodity, have gone way up. And so the picture becomes a little murkier. And if you look just at the macroeconomic thing, Peter, oil price changes have never had much of an effect on GDP growth rates in major economies. So that would be my conclusion to your question.
Okay, Yaroslav, how about you?
Don't look for much change.
Okay, don't look for much change.
This doesn't mean, don't look on the GDP, but look for lots of sectors getting whacked by more fluctuations in the oil prices.
I would agree. I would agree that the overall impact is probably not going to be decisive, but at the margin, this is something that could be a boon to consumers. And overall, it's certainly something that is viewed as a positive factor in terms of the recovery, not just in the developed world, in Europe specifically, but also across the globe. But I completely agree also that there is a risk that such a volatility is going to be hard to stomach for financial markets, for some of the emerging markets. And if you have such a drastic adjustment in commodity prices, that certainly does deliver a shock that may lead to instability and may lead to pressures specifically on the EM asset class.
Let me go back to London real quick. Last word. Are you worried about deflation? No, let me go to London. Are you worried about deflation?
Deflation is definitely a concern, and it correlates with this whole thing. We're talking about a stronger dollar driving down the cost of oil and driving down the cost of the euro, driving down the euro against the dollar. And of course, it's that lower oil price is driving deflation down. In terms of European financial markets, that's actually being viewed as a positive because that just drives the ECB closer to a quantitative easing program, which, as generally history shows us, good for asset prices.
Okay, everything's connected, gentlemen. Fascinating discussion. Many thanks to my guests in Baltimore, London, and here in Moscow. And thanks to our viewers for watching us here at RT. See you next time. And remember, CrossTalk rules. I love you.